Okay. So in financial statement analysis, here we have 6 readings and a sizable weight of around 10 to 15%. So you can expect at least 2 vignettes and maybe 3. Okay. Of the 6 readings, the first 3 readings are where the major concentration is. While doing for the first time, it takes a lot of time, but honestly, in exam, they are not going to grill you very detailed stuff that they have. So I'll clear those myths while we go through, right? Let's start with the first reading, that is intercorporate investments. In this reading, our focus is going to be when your company invests in other companies, right? Then how the accounting of that takes place. So how are we going to account for when we do investments? And that depends on the ownership stake. How much is your stake? Based on that and based on the degree of influence, we will understand the different accounting treatment. Now, overall, to summarize everything, I'll directly go to the crux, right? So there are 4 types of accounting treatment, or based on the ownership, what are the different accounting treatments that we are going to see? Number one, whenever your investment is less than 20%, where we understand that there is no significant influence. When I say no significant influence, means there we record it in the form of same way that we did in level 1, which is treatment of investments in financial securities. There are 3 ways here: amortized cost, held to maturity, and available for sale, which in IFRS is called as the held to maturity is called available amortized cost, held for trading is called FVPL, and available for sale is called FVOCI, right? These are the 3 adjustments that you do when your investment is in the target company or in the subsidiary is less than 20%. There is a high chance something related to this might be asked, so I will go into understanding of the accounting treatment. It is very much similar to what we did in level 1. The second is when there is a significant influence, and significant influence is when the stake is greater than 20% but less than 50%. Beyond 50%, what we call is as a controlling stake. Now, this is where the accounting treatment is different. And the 2 major accounting treatment that we are going to see for 20 to 50% is equity method. And for greater than 50%, which is generally a case in merger or acquisition or consolidation, in this case, we use acquisition method. All right. So these 3 levels of ownership. And then there is a 4th type also, which we are going to see later, that is JV, joint venture, where 2 or more companies come together. Okay. So it's called a shared control. And again, in this case also, we use the equity method. There is another method also, which is rarely used, but we'll rather focus from the exam point of view, equity method. So broadly, there are 2 accounting treatments apart from less than 20%. Sorry. The two accounting treatments are equity method and acquisition method. There is a high chance that in exam they will give you a vignette, which we will also see today. And based on that vignette, they will ask you how the treatment will be. Now, first we will see the 3 adjustments related to the amortized cost, FVPL, and FVOCI treatment, which I've summarized here. So remember, in this case, that IFRS and US GAAP has different names, but the treatment is now the same. So this is investment in financial asset. This is when your investment is less than 20%. Now, if you record it as amortized cost or held to maturity, whichever the name you use, then this is generally for the debt because they have a limited maturity. So on the balance sheet, we always keep the amortized cost, but for the other 2, we used fair value. All right. All right. All right. Now, since it is amortized cost, there is no unrealized gain or loss. But since it is fair value in the other 2, there is unrealized gain or loss, that is increase or decrease in the value of asset, which is either recorded based on the name. FVPL means it's recorded in the income statement, and FVOCI means it's recorded in the OCI, other comprehensive income. This is for unrealized gain and loss. All right. But realized gain and loss, like interest in the case of debt or dividend in the case of equity, is always recorded in the income statement. So income statement is about realized gain and loss, which is the case same for amortized cost, FEPL or FEOCI. Everyone understands this system? Any doubt in this? Everyone, check, check, check. This is something which is highly tested in exam. There is a high chance that this will be tested back in exam. Again, it's the same thing that you did in level 1. Any doubt, anyone in this? Okay, check, check, check. Any doubt, anyone? Okay. Now we will go to the next treatment, that is greater than 20%. What is that greater than 20% called as? Greater than 20%, less than 20% is significant influence? No, it's no significant influence. Greater than 20% is what we call as investment in associate. And more than 50% is what we call as business combination, which can take different forms. But investment in associate and business combination is going to be a major focus now. Investment in financial security is what we did. Now, when it comes to investment in associate, we are going to use equity method. Now, most of the detailed discussion we did when we were doing it for the first time, step by step, we calculated everything. But very interesting thing will happen when we do the case studies. So here, how the treatment will take place, it depends on two parts. One is when you're going to acquire the company at its value, which is based on the fair value. And the second is when you're going to pay the company more than its book value. This is where in the second part will come goodwill. So in the first part, we don't discuss anything related to goodwill. We are going to basically acquire the company or take a stake in the company between 20 to 50%. And we will relatively record the income or dividend in our financial statements. So this is investment in associate. Now directly let me go to the statement here. So here if you will notice, the example that we did is that your company P is investing in company S and taking a 30% stake. So when you take a stake, the income of that target company, in this case S, not the entire income, but only 30% of that company's income belongs to you, right? But when that company pays dividend, instead of deducting the entire dividend, 30% of that dividend will be deducted from your investment account. Remember, when the company is declaring dividend, that money goes out of the system. So that's a cash outflow. All right. However, you will get dividend from the company. So here, under equity method, what exactly is the equity method? Here we are going to record the investments. So when we invested $1,000 at the beginning, but then in the coming year, the company gets proportionate share of the income of the subsidiary or the investee company. So here the investee company earns 400. Out of those 400, our stake is 30%. So 30% of that 400 belongs to us. All right, everyone in the class. So at the beginning, the company's investment was 1,000. All right. And then 30% of 400 is what we will add as earnings, proportionate earnings. And 30% of the dividend will be deducted from our investment account. All right. So this will be our ending investment at the end of first year. Second year, we will follow the same process when it comes to income and dividend. We'll add the proportionate income and subtract the dividend. This is what will be recorded on the balance sheet and on the income statement. On balance sheet, your investment account will be the closing of this. And what will go into the income statement? In the income statement, guys, yes. On the balance sheet, we will be recording our investment value, which will be 1090 and 1225, correct? And is there anything that will go into the income statement? Yes, the proportionate income will be added. However, what about the cash flow? Is there any cash flow here? Is there any cash flow? Cash flow. What will be recorded in the cash flow? Only the dividend will be recorded in the cash flow, because dividend is the only amount that you are actually going to get. All right. So when it comes to the cash flow statement, remember to record the proportionate dividend in the cash flow. Clear, everyone? All right. Any doubt in this till this? Okay. Now this is basically without goodwill. Now, naturally, we pay the company more than its fair value. So there will be a case of goodwill coming up into the picture. Now, when there is goodwill, when we are going to pay more than the company's fair value, how to calculate goodwill? how will be the reflection of that in the income statement and on the balance sheet. That is what we are going to see. So let me take you all to the example that we did. So in this case, the company purchased 30% of the company for 80,000. 30% of the company for 80,000. Now for this is what we paid. We need to compare this amount with what was the company's NAV. All right. So on the acquisition date, the book value of the company's NAV was 200,000. And now also the fair value and the book values of the liabilities were same, except for equipment which they have told us to adjust. So the revised fair value is 25 to 75. So there is a 50,000 increment. So apart from 200,000, we need to add 50,000 for making it fair value. So the fair value of company's NAV that we calculated was 250,000. Compared to that, how much did we pay to the company? We paid 80,000 for 30% stake. All right. So we paid 80,000. Correct, correct, correct. And what happened here? Which had a book value? Okay. Equipment was depreciated. So there is a depreciation also. At the end of the blue reported net income of 100,000 and paid 60,000 dividend. First thing is what they've asked is how much is the goodwill created? Goodwill is the extra amount paid. Now remember we paid 80,000. All right. And out of the 250,000 250,000 is the total value NAV of the company. We bought 75% stake. So 250 into 0.75, basically, how much did we pay? That 250,000 is the NAV. All right. And NAV based on fair value. All right. So 250,000 is the fair value based NAV. And how much did we pay? We paid 80,000, but that is for 30% stake. All right. So what is the process of calculating goodwill here? There are two ways of calculating goodwill that we saw. Is one is that whatever is the purchase price, from that we adjusted the pro rata book value of net assets. Now this is the book value, book value, book value. Now, but in this book value, remember the book value after adjustments of 200 plus 50 was 250,000. So guys, on this 250,000, of this 250,000 into 30%, that is 75,000 is my proportionate book value, and we paid 80,000. So there is 5,000 paid extra, which becomes our goodwill. Everyone, correct? So what is a goodwill? Goodwill is the proportionate amount that we paid extra. So one thing is that how we calculated the investment value is this: beginning value plus net income proportionate, dividend proportionate. That is going to give me ending investment value. Correct. And now about goodwill, how do we record the goodwill? Goodwill is the additional price that we paid over and above the fair value of the net assets. We will come to this slide in a moment. This is how we recorded goodwill: extra amount paid over and above the proportionate fair value of the asset. Now, the second question which was asked here is that what will be the impact on the income and the investments? Income, calculate RED's income at the end from investment in blue. Now, RED's income, guys, we are doing which method? Equity method. In equity method, RED's own income was how much? RED's own income, have they given us RED's own income? Yes. Blue's net income they've given me is 100,000. Correct, correct. Okay, so how much from that company will be added to our company? All right. So remember here, blue, 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 and red. At the beginning, red company purchase. So red is taking over blue. So they have asked us calculate red's income at the end of the year from its investment in the blue. Now, blue's net income is 100,000. Of that, 30% belongs to us, isn't it? So why? Because we have a proportionate share of 30%. However, along with that, there was a revision in the book value, which was an addition of 50,000. Because of this, there will be an extra depreciation, and based on the life, which is 10 years. So there will be an extra depreciation of 5,000. So even though here we get 30% of the proportionate share, there is an extra depreciation of 5,000. Of that, also 30% is what we will deduct and that final amount will be our equity income or income from the proportionate share in the target company. All right. So what did I do? I just did not take the net income, but always check if there is any increment in the depreciation. If not, then skip it. Then only the proportionate income is your addition in the net income. All right. Okay. Check out for depreciation. If there is no depreciation, just take their income into the percentage is your proportionate share. Clear? Now, finally, when they ask me the investment account, so that's where I will follow three things. I'll take the beginning investment value, proportionate net income, and subtract the dividend proportionate, if any. Same like what we did before. So our investment was 80,000. We bought 30% stake at 80,000, and 30% of the net income will be added, adjusted for depreciation, which we already calculated as 28,500, and dividend which was declared, 30% of that will be deducted. So how much dividend were declared by this company? 60,000. So 30% of that will be deducted. That is going to be your balance sheet investment value from this company. All right, everyone. This is how a typical equity method is, whether there is goodwill or no goodwill. Any issue with this? Check, check, check. Anyone? Easy, relatively. Okay. Any doubt? Anyone? Okay. Now, remember, when it comes to goodwill, there are small discussion related to goodwill that I wish to do is about full goodwill and partial goodwill. What is a full goodwill and partial goodwill? Let me take you to that point. Where is this full goodwill and partial goodwill? Check, 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 check. Okay, business combination. Do we have it here? Okay, that we will see later. Let's go in the flow. So after this, okay. Now remember, before we go to that full and partial goodwill, we are under investment in associates. Okay. Here, what we did is the equity method when there is a goodwill or when there is no goodwill, right? Now we did investments in associates with the equity method, correct? Now, here there is some additional discussion that when there are transactions with the investee company, these are called upstream and downstream. This is something that just for your general knowledge, I wanted to add, might be tested in exams in the theoretical form. What exactly do you mean by upstream and downstream? Upstream is from investee to investor, any transaction from investee to investor, and downstream is opposite, from the investor to the investee. There is a transaction of buying and selling goods, so the profits will have to be adjusted. So what will be the issue here? There is any uncertainty that will be adjusted from the account. So because this happens when there is a transaction between the investor and investee. Okay. Upstream between in from investee to investor, and downstream is from investor to investee. All right. How the treatment is, you can go into the detail. Otherwise, if you have time, otherwise you can just simply understand what is upstream, downstream. Just one common thing that I want to highlight here is that in an upstream sale, investee has recognized all the profits in the income statement, all the profit that it is going to get from selling it to the investors. However, if there is any uncertainty, that must be eliminated. So any proportionate thing that you think that will be returned back, that needs to be eliminated. Similarly, in the downstream, that is from investor to investee, here the investor has recognized all the profit because investor has sold the goods, right? Like upstream, investor also must eliminate the proportionate share if there is any unconfirmed amount. If there is any uncertainty, both investor or investee should what do? They should eliminate that unnecessary or uncertain amount. All right. This is what you need to know from your revision point of view. Now we move on to the third type of transaction after investment, where your influence is less than 20%. Now we just did in associates 20 to 50%. Now greater than 50% is business combination. Business combination happens due to merger, acquisition, or consolidation. Technically, there is minor difference, but for your accounting, it is generally the same. In this case, we are going to use acquisition method. Now, how does an acquisition method differ from the other method? For this, you need to check on the balance sheet here. We will see the balance sheet income statement comparisons and between the acquisition method and equity method. What do you notice that in equity method, have we added all the numbers, current asset, current liability? No. In equity method, we keep all the information about the acquiring company, all right? And only the amount that you paid to the target company as well as the investment in the target company, that is a separate line item showed. So only one thing is different in equity is that is basically the investment account is adjusted, and of course the cash that you paid is adjusted from the current asset or the cash. Otherwise, you will see all the information about the acquiring company only. Are you with me, everyone? Everyone? In fact, if you can check the stock and retained earnings, here you will see the stock and the retained earnings also the same. However, in acquisition method, you add everything. So what we do is that in the acquisition method, if let's say here my current liabilities were 40,000 and here it was 14,000. So 40 plus 14 is 54 is what we added. We do the same for current asset and all other asset. Just remember that in current asset, even though we are going to consolidate, we need to subtract for the cash paid. Okay, so therefore there is minus it. So consolidate or acquisition method is where we add everything. Therefore, the assets and liabilities values are higher in acquisition method compared to equity method. All right, everyone, check, check, check. Also, there is no separate line item under the assets as like in equity method, like investments. But the proportion, because I'm consolidating, I don't own 100% of the company. So the proportion that we do not own, that is shown separately as minority interest under the liabilities. Are you with me? All right. So naturally, in where will be the balance sheet values be higher? Under which method? All the balance sheet values will be higher under everyone? Acquisition method, right? In equity method, there is only one line item adjusted extra. Also, second thing, the question that you need to focus is on minority interest is visible in acquisition method. In equity, there is no minority investment. There is investee account, which is proportionate, which is your investment and proportionate share of earnings and dividend adjusted. That is what happens in equity account. In acquisition method is actually more simpler. You add all the assets liabilities, correct? And whatever proportion you do not own, that you show separately as a minority interest. All right, all right, understood. So the proportion that we do not own. Same way, we will analyze the income statement. In income statement also, you will see that under the acquisition method, what happens is that we consolidate the revenue of both the companies, expenses of both the companies. So the total revenue and expenses look higher, but the net income is same under both the method. In equity, what we do is that we take the equity or we take the revenue and expenses of the acquiring company only, but the proportionate investment, the proportionate earnings of the target company, let's say in this case 80%, because they must have taken 80% share of the company. So proportionate shares of the target company's net earnings is added in equity method. In acquisition method, you simply add everything and proportion that you do not own, that minority interest is shown as a negative item. Overall, the net income is same. Again, ring the bell. The total revenue and expenses are higher. Net income is the same under acquisition and equity method, right? Minority interest is only visible in acquisition method. Clear, everyone? All right, all right, all right. This is the major adjustment, or this is the major information that they are going to ask. Okay. Then came the discussion about the goodwill, which is full goodwill and partial goodwill. By the way, full goodwill and partial goodwill, these are technically slightly different. In why do we, by the way, study these two methods? Because full goodwill is a compulsory method required under US GAAP, and partial goodwill is not allowed under US GAAP. It's only allowed under IFRS. In full goodwill, the purchase price that you paid is for some share. So we take the whole value of the company based on the purchase price and subtract the fair value of its NAV. So what we do is that whatever is the purchase price that you paid, for example, Wood Corporation paid 600 million for all of the outstanding stock. So that is the total value, right? Minus the fair value of the net asset. So that difference is called the full goodwill. So purchase price minus the fair value of the net asset. This is my full goodwill. Okay. In partial goodwill, we don't take the purchase price divided by the percentage share. We take the purchase price only. So basically whatever you paid, that will be the case. And the fair value of the identifiable assets of the subsidiary, net asset of the subsidiary, those those into the proportion owned. Now, ideally, they both should be giving you the same value. There should not be a major difference unless and until sometimes, they do some changes in the NAV. So accordingly, there might be minor changes. Otherwise, you will see most of them, they have the same amount. So here you will see in the full goodwill method, what we did is that we took the whole value. So here they have said it's 75%. So imagine you paid 70, you took 75% stake of a 600 million company. So you paid 600 million to them. All right. Correct. That was 100% minus the fair value of the net asset, which we had already calculated here. Fair value was 560. So we had got it as 40 million, right? No change. But in the partial goodwill, I will only consider the amount that I paid, which is 450 million, correct? Minus what I do is that I take the proportionate share of the NAV of the company. So proportionate, that is 75% of 560. I get here now the value of goodwill is slightly different. Here it is 30 million instead of 40 million. Okay. So you will see there is some minor change, correct? Overall, the full goodwill method, they result in higher value that you see here. So please focus that the full goodwill method results in higher total asset and higher total equity than the partial goodwill method. Remember for your exam that full goodwill method is required under US GAAP and allowed under IFRS. But partial goodwill is not allowed under US GAAP. So there is a high chance about the full goodwill being discussed. All right, everyone? Correct. Second thing, you remember goodwill is never amortized but tested for impairment at least annually. This I'm sure everyone has freezed up in their head. And goodwill, when I say tested for impairment, US GAAP and IFRS, do they have same method? No, different methods. IFRS is pretty much simpler, but US GAAP has a two-step process. Everyone does remember this? How the goodwill impairment takes under US GAAP. First step, you will check whether it is impaired or not, where you will compare the carrying value with the fair value. And if the carrying value is higher than the fair value, then number one, yes, there is goodwill, which is to be impaired. Once it is decided, then you compare that goodwill. Then you will have to calculate the impairment loss. So for impairment loss, what we do, we take the difference between the carrying value and the implied fair value. What is implied fair value here? It is exactly the same that we did in the acquisition date. We will calculate the company's reported value, net NAV value, and we will calculate basically how much amount we were supposed to pay as of today. So implied fair value is calculated at the acquisition date. At the acquisition date today, if you basically how much you've paid for the company, and today what is the NAV, that extra amount is considered calculated as goodwill. That is called implied fair value, which is ideally estimated value. Understood, everyone? This this is US GAAP is a two-step process. First, you have to test whether goodwill is or whether goodwill is impaired or not, and then you need to compare with the implied fair value and calculate. Implied fair value is the fair value of the company's NAV on the acquisition date, for which we had done example in the class. We compared the carrying value with the fair value. Since the carrying value was higher, we did the goodwill. For that, we calculated the implied value of the goodwill, which was here 175. How did we get 175? Implied means today on the acquisition date, whatever is the NAV, fair value of the NAV, correct? And based on that, net asset was this, and we must have been given the liabilities. The reported acquisition goodwill was 200,000 minus the fair value of the subs net assets. Okay, so we were given the fair value on the acquisition date. The fair value was 950,000 and the fair value of net asset is 775. Okay. At the end of this year, the fair value, okay, of sub is 950,000, correct? And the fair value of the subs asset was last year. On the date of acquisition, the fair value of subs net asset was 800,000. Parent reported acquisition goodwill 200,000 at that time, initially, okay, when they bought the company. Then on the date of testing the impairment, at that time we recalculate. At that time, when we recalculate on that day, the implied goodwill turned out to be 175 because we are going to do the fair valuation of the company on that day. And the carrying value and all of those are compared. So here at the end of this year, the fair value was 915. The fair value of subs net asset is 775. So what would be the fair value of the company and the net asset is recalculated on the impairment date and then tested again. That is your implied goodwill. So one goodwill is actually the amount that you, when you bought the company. And the second goodwill that the implied fair value is what we calculate. What is the difference between normal fair value and implied fair value? Normal fair value, we use it when we are calculating goodwill, but that is when you acquire the company. But when you're testing for impairment on that day, the fair value is recalculated and the goodwill overall is recalculated. That is called my implied goodwill. Okay. Very complicated it looks like, but it is not, because most of the information will be provided to you. Okay. The last thing here was about joint venture. In the joint venture, we are going to use the equity method. Remember, equity method is where we do what? We take only the proportionate of income, correct? Or investments into our financial statements. However, there is a slightly different method here, which is called, rarely used, although, which is called proportionate consolidation method. Now, what is proportionate consolidation method? Same as acquisition, where we are going to consolidate everything, correct? Except that the investor only reports the proportionate share of the assets and liabilities, which means instead of adding all together and then showing minority interest, here we are just going to add not the 100%, but the proportion of the company, whether it's asset or liability. So there is no need of minority interest. Okay. So see here in proportionate consolidated method, did we take the entire company's assets and liabilities of the subsidiary? No, we take the proportionate share only. All right. And therefore, you will not see any minority interest here. Minority interest here. Correct. Same way, when it comes to income statement, we are going to take proportionate share of revenue and expenses. Again, there is no need of minority interest. All right. So guys, the total amount is higher under which method? Now, overall, you've seen three methods: acquisition method, proportionate consolidation, and equity method. Total revenue is higher under which method? The acquisition method, then proportionate consolidation, and then the equity method. But the net income is always same amongst all the methods. Remember, there is no difference in the net income amongst all the methods. Clear, 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 clear. So there is a summary about all of this, which I need to discuss with you at the end. See here. Since the net income is same under all, okay, what happens is that when I look at the net income margin, the revenue amount is different. The revenue is highest under acquisition method because you're going to combine together. So therefore, the net profit margin is lowest under that method. All right. Everyone, proportionate is next and equity is relatively higher. Why? It's because of the higher sales which is recorded in the acquisition method. ROE, which is net income over total equity, and net income is same across all. But again, the total equity is higher under acquisition method. However, under proportionate consolidation and equity, what happens is that the total equity is same. Let us see that. How come the total equity is same under these two methods? So here, if you will notice that the total equity, that the common stock and retained earnings are same under both the method, there is no minority interest here. So therefore, the retained earnings and equity being the same, the ROE impact is same under equity and proportional consolidation. But again, acquisition method, the ROE is less because the total equity is more. ROA, return on assets. What about the assets? Assets are highest again in the acquisition method. So ROA will be the lowest there. Then comes proportionate consolidation and then comes equity. Correct? So the impact of ROA and net profit margin is same, that you need to understand when you are comparing these three methods. All right. Very, very important from the exam point of view. Correct? We had also discussed about contingent liability. What is that we need to do with regards to contingent liability adjustments? These are issues apart from what we discussed. So these are other issues which happens when you're consolidating your business. So we discussed about contingent asset and liability and contingent consideration. Two are different things. Contingent asset and liability, IFRS and US GAAP has a slightly different treatment. It's very complex. So what I'll do is that I'll just focus on the summary that we did here. So in contingent assets and liability, if there are any contingent liability, IFRS and US GAAP has slightly difference. IFRS, what IFRS says that you need to measure it at fair value at the time of acquisition for liability. But contingent assets are not at all recognized under IFRS. IFRS is more conservative. So they do only record contingent liability, which you might have to pay up in the future. Contingent assets are not recorded. US GAAP actually divides contingent assets and liabilities into contractual and non-contractual. Contractuals are recorded at fair value, but non-contractual are something that which are more likely. Understood? Recorded, they are recorded only if they are possible, or only if there is a possibility. Otherwise, they are not recorded. Okay. So they do not meet the definition. So those who meet the definition and those who do not meet the definition. That is what the difference between contractual and non-contractual is. Contractual, remember, are recorded as same way as on the fair value of the acquisition date, but the non-contractual are also recorded. Are they recorded? Yes, they are also recorded. However, there is a condition. If they meet the definition of asset and liability. Now, this is very complex, so I'm just focusing on this. If they meet the definition, then they are recorded. So US GAAP is slightly complex. There's no clear recording or not recording. IFRS says only liability record, asset don't. US GAAP doesn't differentiate between asset and liability. It differentiates between contractual and non-contractual. Okay. What is contingent consideration? Contingent consideration is that when you acquire the company, there is a chance that some amount might be paid later. Okay, it might not be paid now. So in contingent consideration, there is some amount payable to the former shareholders of the subsidiary if the target has been met. They are saying that this has to be recorded at fair value and it is to be recorded under IFRS and US GAAP both. Correct? So under both the cases, you have to record if there is any contingent consideration. Okay. In process R&D, the R&D which is currently going on, right? It is capitalized as an intangible asset. Remember, in process R&D is capitalized. Now, when I say capitalized means it is added in the assets. This is common treatment in the IFRS and US GAAP, right? Restructuring costs are one time. So restructuring costs are expensed whenever you incur. All right. This is the differential treatment apart from the other treatment under business combination. Clear? Clear? I have just summarized here about goodwill, full goodwill, partial goodwill, how the goodwill impairment takes place under IFRS and US GAAP. Correct? That's all that you need to know from this particular topic. Very complicated and lengthy, but that's what the first three readings are. Now, when we see the questions at that time, you'll get more clarity that it sounds very complex, but it is not. Majorly, your focus has to be on the three methods, that is equity method, acquisition method. Proportional consolidation method is rarely asked. But then the focus is on when your influence is less than 20% under the investment in financial securities, where we discuss amortized cost, held to mature, which is held to maturity, FEPL, FEOCI. Those are some common types of questions that you will see, and we will solve many of them. All right, everyone? Clear? Perfect. Okay. Now, this is one of my favorite topics, that is employee compensation. And here, majorly, we are going to talk about two things, that is share-based compensation, and second is about pension, right? Previously, this topic was only focusing on pension to a large extent. Now they have compressed that focus. Now, initially, we discussed too much about stock option when we were doing it for the first time. And there is a plethora of information related to this stock options. From your exam point of view, what you need to understand is some important terms. Although we have mentioned many of this in the formula in the class, so I would suggest you to focus on those terms rather than getting deviated. So in the 4 or 5 pages, I've summarized those terms that you need to know, and I would suggest you to only follow that. Okay. Otherwise, there is so much of information that you'll get confused. All right. So let's start with that. So we are moving into employee compensation. Okay. Now, in this employee compensation, first, as I said, we are going to discuss about share-based compensations. But before that, there is short-term and long-term compensation. Short-term compensation is like your salary bonus or wages. Long-term, which is beyond 12 months, is when the company pays you for disability or any paid leave that gets accrued for your couple of years of services. But the more important focus here will be the stock-based compensation, number one. And the second is post-retirement benefit that we are going to discuss is DB and DC plans. So stock-based compensation and post-retirement are the crucial long-term compensation paid by the employer, and that is what we are going to discuss. First, we need to understand that these compensation are not given immediately. They are given only when you meet certain criteria. For example, most of the compensation is being delivered to or is being paid to you after a vesting period. What is a vesting period? Vesting period can be anything. For example, for salary, that vesting period is 30 days. After 30 days, you get your salary. But for stock options or pensions or other things, your vesting period is slightly longer. Okay. It can be a couple of years after which you get eligible for those benefits. Right. Here, our focus is going to be mostly on stock options. And then when I say stock options or grants, they are the same thing. So one is share-based compensation, and then we are going to look at the retirement and other benefits. Okay. So let's focus first on the stock options. Stock options, and then there is something called conditional grants and stock grants. What is the major difference amongst all this mess that I've done here? Is that stock option is a choice given to the employees to buy the company's share. However, the employees will only buy them if the option is in the money. So these are contingent. They are not sure that they will be exercised. Okay. So how is the compensation calculated for expenses by the company? Because company is going to give you compensation. So this is an expense for the company. And whenever I say the expense, what happens? The net earning goes down, or the retained earnings will go down of the company. So company's equity and profit both will go down whenever the company recognizes this expense. So yes, stock option, even though it is dependent whether it will be exercised or not, the company being, because it is allocating this benefit to the customer, like giving a salary, this is expensed. Are you with me? Right? Right? Okay. So if you look at here, that compensation expense is equal to the fair value of the option on the grant date. On the day of option, or on the day of granting the options, whatever is the fair value of the option. How do I determine the fair value of the option? It is determined using any model. For example, here we use the model of Black and Scholes, which is generally allowed in most of the reporting. Uh, Ideally, you can use any option pricing model, including Black and Scholes. IFRS and US GAAP do not mandate a particular model, but mostly Black and Scholes is more acceptable. It should be sound. So we are going to use Black and Scholes model, and all the assumptions should be disclosed about the valuation. Once the fair value of the option is determined, that fair value on the grant date is amortized, but that amortization is divided by the divided by the vesting period. So imagine this option are granted to you and the fair value of this option is determined and the vesting period is 3 years or 5 years. So divided by those years will be your expense. It cannot be at one go, it will be amortized. So that will be the expense that will go into your income statement. All right, everyone understood this? How to determine the compensation expense? Clear? Now, this is what happens in a stock option. In a stock grant, they are going to give you some shares. Okay. So the market price of those shares on the grant date and the number of shares that are going to be given to you, grant is like a free thing. Okay. That is the value of your stock grant. And this value again divided by the vesting period will be your expense. All right. Now remember the difference between conditional stock grants and performance shares. What is the difference between those? Is that the criteria that you will get the stock grants or performance share is based on something like, let's say, the performance of the company share or ROE or EPS, any particular criteria. Based on that, you will get the stock grants. I've got a question that is it a straight line? Yes, it's a straight line amortization. So whatever is your value of the grant divided by the vesting period, it's a straight line amortization. All right, correct. So the expenses should be recorded in the income statement. It's a straight line divided by the vesting period. Clear? In fact, if you will see the example that we did while we were doing this in the class, is that we calculated the value of option and stock grants, which was given to us based on the market price. And put together, that was divided by the vesting period, straight line. This is the compensation which will be recorded in the income statement each year. All right, correct. Understood how the expense will be recorded? Clear, clear, clear. But will there be any effect on the company's cash flow? No, there is no effect on the company's cash flow until that is going out from the company's account, right? So when they say about any impact on the company's cash flow, no, there will be no impact on the company's statement of cash flow on the grant date. There is impact on the income statement. Yes, no impact on the cash flow. What about the balance sheet? Increased in share-based compensation because you are going to give compensation to the employees, correct? But the thing is that these are given additional shares. So your retained earning goes down, but your equity capital increases. So overall total equity remains the same. So three things, your because of the compensation expense, your income statement, your profits will go down. Equity unchanged. That's why there is no effect on the balance sheet. Net effect on the balance sheet is nothing. And there is no cash flow impact because there's no cash actually given. These are the three major adjustments that you need to remember. All right, everyone? Clear? 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 Okay. Now, I've seen many times that they ask you a question, a theoretical question related to what is tax shortfall and tax windfall. Have you heard about that? Right? We have seen that in the class. What is a tax shortfall and tax benefit? There is something called tax benefit also. Okay. So what is that tax shortfall and tax benefit that we are going to see? This generally happens because you are going to pay the expenses. And what if the actual amount, or see, the financial reporting is done on the grant date, but actual amount is given to the employees, or the amount that they are going to actually get, do the settlement is going to happen later, right? On that day, what is the amount? They both are not the same. Okay. So for financial reporting, compensation expense is based on the stock price on the grant date. But for tax purpose, it is only allowed upon settlement. So when the actual happens, correct? Because of this, there will be, and of course, there will be change in price, isn't it? So what is the tax deduction for stock grants? See this. Share price on settlement date into number of shares, and tax deduction for option is intrinsic value into number of options. So this is basically what it is going to give me the stock deduction for grants or for options. Okay. Now, what is the difference here? Here, when I say tax deduction, if the stock price on the settlement date is higher, which is not naturally going to be the case, isn't it? The tax deduction will be higher than the cumulative compensation expense. So what I recorded as an expense on the grant date, older share price will be less, but the tax deducted will be actually more. So that's a benefit, right? So that's an excess tax benefit or called tax windfall. Remember, this happens when the share price goes above the price which was on the grant date. There's always a tax windfall. But rarely in the case, if the prices go down, then there is a tax shortfall. Remember, tax gain or tax a benefit which is called tax windfall, and whenever the share price goes down, that is a tax shortfall. Any gain is never recorded in the income statement to make it volatile. It is this gain or this shortfall that directly taken to the equity under IFRS. All right. But you know US GAAP. US GAAP will do what? Any windfall or shortfall basically will be adjusted in the income statement. Most of the time there is a windfall. So this will do what? This will be added in the income statement. So what will happen? If there is a tax windfall that is a benefit, it will be added, means what? Your tax expense will actually go down. And US gaps, the hidden benefit of US gap is to reduce the tax bill. So this will be added up in the income statement, unlike IFRS where everything is directly taken to the equity. So when there is going to be more volatility due to this changes in the stock price, that is going to be under US GAAP. Are you with me? So this tax windfall and shortfall creates volatility in the income statement under US GAAP, not under IFRS. Clear, clear, clear. Okay. Everyone understood? Okay. The next adjustment that we all know, which we always do, is that the dilution effect. What is the dilution effect? Remember that if the options are exercised, more shares will be released. And when more shares will be released, what will happen? The number of shares, because of the increase in number of shares, the earnings per share will go down. That is called dilution, isn't it? So these are potentially dilutive securities. Clear, 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 clear. So if a company reports net loss, then there is no dilution. Dilution will generally happen when the companies will report a net loss. No, when the company share price is expected to go up, in that case, there will be dilution. All right. So remember, what is going to be the dilution? The increase in the number of shares, that is going to be potentially dilutive. If they are included, okay. If the company reports a net loss, basic and fully diluted EPS will be the same. So in that case, there is no dilution, anti-dilutive. But how will I know that expectation? Okay, such increase in EPS over the, okay, that is subjective, that is fine. What is the situation? Yes, here. When it comes to how much, there is a high chance that they will ask up in exam how to calculate the dilutive shares. Okay, remember here we use the treasury stock method. So first what we do is that we will find out how many shares can be repurchased by the cash that you receive from the dilution. So we need the cash proceeds. Cash proceeds is basically when investors subscribe to the option and then they pay cash to the company. From this, we will first subtract or adjust the unrecognized share-based compensation expense. This one item we need to adjust if they give so in exam, that unrecognized expense, unrecognized value of compensation which is due, that needs to be reduced, that has to be deducted. Okay. That proceeds, that final proceeds that you get, divided by what? So that is the final amount that you will get overall. This amount is what the company will receive. from this amount, what the company will do is that the company can actually buy its own share back. So average, okay, this is fine. So once I get the assumed proceeds divided by the average share price, not the closing share price, that is going to be the number of treasury shares that the company will take back. So company will issue shares, and whatever shares the company can take back, the net issue is what goes into the calculation of weighted average shares outstanding. All right. All right. So assume proceeds here that you got number of treasury shares. These are the shares that the company will take back. So the net shares that the company will release is what we call as dilutive shares. Remember, don't stop till calculating treasury shares. These are the shares that the company will repurchase. So that needs to be deducted from the shares issued due to the option exercising. The net is what goes into the calculation of EPS. Clear, everyone? Okay. Here, just remember some disclosures. IFRS requires disclosures regarding share-based compensation. Okay. To the extent that that fair value was determined and what is going to be the impact on earnings, that is diluted EPS. Clear? Remember, we don't report anti-dilutive EPS. We only report the diluted, or we keep the basic EPS. All right. Correct. Correct. Now, are we going to see any share-based compensation separately in the financial statement? No, because they are part of the employee compensation. So either they are recorded in cost of goods sold if it's a manufacturing company, manufacturing employees compensation, or selling general and admin if it's a management related compensation. So you won't see them as a separate line item. You will see that already adjusted in along with the other compensation that you give for the employees. All right, correct. However, separating share-based compensation, is its treatment in the cash flow statement. Yes. Whenever we are going to do the forecasting of the cash flow for share-based compensation, whatever we do, right? Where is it recorded? In the forecast statement of cash flow, share-based compensation should be added back to the net income to arrive the CFO. Why? Because remember, share-based compensation is given to the financing stocks, equity and equity shareholders, right? So it's a part of CFF, not a part of CFO. So we need to adjust if there was any compensation given. We need to, if that was deducted, we need to add it back. Okay. The expected cash inflow from exercising of the option. When investors exercise the option, that's a cash inflow. So that's a CFF inflow. Remember these two cash flow treatment? It's a CFF inflow when they exercise the option. Clear? 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 Okay. Yes. What else is important? Okay. Now the second part of the topic talks about the pension. There are two types of pension plan, DC and DB. Where do we record asset and liability? Asset and liability is recorded in the case of DB plan. Now, do we record asset or liability? Well, we record the net, which is the funded status. When I say funded status, that is about the balance sheet. In the balance sheet, remember, there is a liability which is called projected benefit obligation. This is the expected benefit that the company has to pay, which has a very detailed calculation, which we will see. And then according to that, the company has created some assets to pay this pension. That is called plan assets. Okay. So PBO, projected benefit obligation, and fair value of plan asset together will determine what's your funded status is. If the fair value of your plan asset is higher than the PBO, then we call it as a, if the fair value of asset is higher than the PBO, we call it as a overfunded plan, which is an asset, correct? But if it is lower than the PBO, then it's an underfunded plan, it's a liability. All right. How is the pension calculated? Pension is calculated as some percentage of your final salary into the number of years of services and so on. In reality, every company has their own pension calculation formula, but three things are always there in the pension that I need to show you. In the pension, you will have some percentage of the final salary into number of years of services. That is going to be your pension amount. We already discussed about the overfunded and underfunded status. Now, there is a high chance that in exam, they will ask you to calculate the effect of how the FV of fair value of plan assets and PBO takes shape. Okay. Now, this is where what we've written in the formula is important. So that's why I directly moved to the formula part rather than going into step by step. Okay. There are three treatments that you need to understand. The treatment on the balance sheet is about the funded status. All right. Then about income statement and then about cash flow. But the component which goes into the calculation of fair value of plan assets or PBO are the same that you will see in the income statement. All right. Now see, you will have the beginning value of asset and liability, correct? Now, your fair value of asset is related to your investments. So what goes into your investments, that is added, and what will reduce your investment is subtracted, as easy. So any contribution by the employer will increase your investment value. Any returns positive will be increasing your assets value. But from that asset, if anything is paid to the plan, that is any benefit is paid to the retirees, that will be subtracted. So fair value of plan asset beginning plus employer's contribution plus returns, the actual returns minus any benefit paid, that is going to be the ending value of the plan assets. All right, right? But present, the projected benefit obligation, apart when I'm going to calculate the ending PBO, now that is related to the liability, which is the employees. Okay. So how will my liability increase? That is where we need to understand all the components of current service cost, past cost, interest cost, okay, actual gain and loss, and the benefit that are paid will also be here because that is also going to be a part of your PBO. Any benefit paid will reduce your liability. Remember this. So all other things are added except the benefit paid, which will reduce your liability. PBO is a liability. All right. Now, what are these individual things? Current service cost, past service cost, interest cost, and actual gain and loss. Now, they are also the component of the income statement. Current service cost. What exactly is current service cost, guys? Current service cost is all the benefit earned in the current period. So one more year that you work for that, what is the benefit that you are supposed to be paid? That is the current service cost. Understood? But you're going to be paid not only the current year benefit, but the previous year benefit. So is there any change in the previous year's assumptions or any amendment in the previous year's service benefit? That is called prior service cost. Understood, everyone? Current service and prior service cost. Check, check, check. Clear, 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 clear. Okay. Yes. So prior service cost is any amendment in the pension plan, correct? Will increase the benefit for the prior year service. The PBO is immediately increased by the present value of increased benefit already earned. So PBO is effectively understated by amount of past service cost. So in your exam, remember, if there is any amendment, only then comes the prior service cost. Otherwise, there is only current service cost. Understood, everyone? Clear, clear, clear. Okay. Now, when we will look at income statement, there is a difference on where is this recorded in reality. Okay. Now, what was your liability till last year? That liability will increase with time value of money. So whatever is your beginning PBO into the rate of discounting, that is called your interest cost. Remember, the interest cost is due to the increase in the liability of your PBO. Okay, this is not actual, but this is going to be increased because see, when you calculate projected benefit obligation, it was present value. Now, every year you will keep on increasing it. So because when you got the present value, now you're going every year ahead. So you will keep on increasing that with the same discounting rate that you derive or you used while calculating the PBO. Okay. Then the fourth component is actual gain and loss, within which there are two things. One is the gain or loss due to decrease in PBO or increase in PBO caused by any changes in the assumption. Remember, PBO is an assumption. So any changes which will increase or decrease the cost, that is going to be one component that is due to the changes in assumption. This is just because of change in assumption. But the second component is because of the two things related to the asset, that is your expected and actual return difference. Actual and expected return on the asset. Okay. This is generally recorded in other comprehensive income. Okay. So actual gain and loss, also called remeasurements in IFRS, right? That has two components. One is any change in the liability, and second is the difference in the assets expected and actual returns. All right. That together is actual gain and loss. Basically, it is related to the changes in asset and liability because of your assumptions. Okay. Under IFRS, they are never amortized. So it is recorded at one go. Under US GAAP, they are amortized using a corridor approach. I would suggest you to remember corridor approach only if you have time. Otherwise, you can skip that corridor complicated approach. What you need to remember from the exam is this, that in your income statement, current service cost is the cost of working one more year extra. It is always recorded in the income statement under IFRS and US GAAP. The problem is with past service cost, which is due to amendment. US GAAP says put that in OCI. IFRS says no, put everything into the income statement. It is only actual gain and loss which they both want to put up in OCI. Okay. But interest cost and expected returns are recorded in the income statement under IFRS and US GAAP. Now, when this something you will have to write or memorize or remember. When you see the pension expense, I have actually summarized them here under US GAAP and IFRS. What you'll notice here is that what are the components? Current service cost, past service cost may or may not be there, interest cost, and then expected rent on the plan asset, expected return on the plan assets. Okay. This plus or minus any loss or gain. Now see this. This is where there is a minor difference between the both, which I want to show you. Where is that difference? Okay. Yes, check here. In the US GAAP, what you will notice is that current service cost and interest cost. What is interest cost? Is the time value of money cost, which is actually the same thing. However, this will be minor difference in the IFRS. Expected return on plan assets and expected return on plan asset, these two things are calculated at different rate under US GAAP. IFRS says no. Why different rates? They both are calculated at the same discounting rate, and therefore only the net difference is taken. Yeah, remember, expected return is based on plan asset and interest rate is based on plan benefit projected benefit obligation. So in US GAAP, they both are presented separately because they both use different rate. In IFRS, they both are netted. What nets your PBO and plan assets? That is a funded status. So whatever is your funded status at the beginning times a single rate, there is no different rate. That is going to be your net interest cost. Understood this biggest difference? Biggest difference. In US GAAP, they both are calculated separately. In IFRS, they both are netted based on the beginning funded status. Remember this. Clear, clear, clear. Everyone, check, check, check. All right. Okay. This is the only important thing. Okay. Then there is discussion about the corridor approach, which I would suggest you can skip it if you are too much worried about a lot of pension adjustment. Just remember one thing, that any actual gain and loss is adjusted in OCI. Okay. But slightly minor difference. Otherwise, ignore the past service cost for your reference. They are only there if there is amendment. Past service cost has a differential treatment under US GAAP and IFRS. IFRS is more or less straightforward, everything into the income statement. US GAAP has this issue of what will go into income statement and OCI more often. All right. For your exam, I want you to remember this calculation of plan asset and PBO, because there's a high chance that they will ask you what is going to be the impact on the company's balance sheet and income statement. And yes, of course, the cash flow. What is going to be the impact on the cash flow? Cash flow, cash flow. Will there be any impact on the cash flow? everyone? Cash flow, actual cash flow is the employer's contribution only. That's it. Because that's the only compensation that is going to be given by the employer right now. That is the contribution. There is no other cash flow. The rest of the cash flow will be paid when it is due. Okay. Paid when it is supposed to be. So cash flow, there is only one, that is employer's contribution. That is the only thing in the cash flow. Clear? Clear, clear, clear. Okay. Again, one just important thing when it comes to modeling the pension, remember that pensions costs are not shown separately. They are a part of your expense itself. So either it's in COGS or selling general and administration. Okay. However, if there are any changes, they have to be disclosed in the footnotes. Correct? Detailed forecasts are not needed for smaller plans that are well funded or closed. So only details of those plans which are very long term in nature only, and that they have a material impact only, they are disclosed, otherwise they are not. All right, clear? Remember that whenever you're going to value the company, in that case, if the plan is underfunded, the company will have to put additional money, even though that's not a compulsory liability, but that has to be considered as a liability when you're going to be valuing the company. So whenever you value the company based on, let's say, value of equity, based on any other concepts like they have said here, EV, enterprise value, in that case, along with other liabilities, any underfunded status liability also needs to be adjusted. Clear, everyone? Perfect. Okay. Yes. Perfect. All right. Yes. Okay. We now start with multinational operation. Now, to be honest enough, if you go into the reading, there's a lot more information which I will discuss. Majorly, our focus is going to be on transaction exposure and translation exposure. Transaction exposure is the change in the currency from the date when the transaction takes place to the balance sheet date, that is at the end of the year, or basically at the later date whenever you're going to actually receive or pay the amount. Okay, because today I buy or sell the goods, the money will be paid or received later on. So during this period, whatever is the change in the currency, that is my transaction exposure. All right. So you must have seen later on that what happens is when there is a change in the currency from the date. For example, if you have receivables and payables, we discussed here that if you have receivables, you want the foreign currency to appreciate. But if you have payables, you want the foreign currency to depreciate. Okay. Only then you make gains. Otherwise, there is a loss. Okay. The transaction date, the payment date, and in between that, there might be a balance sheet date, which is at the end of the period. During this time, whatever is the gain and loss from the transaction to the balance sheet date, that's an unrealized, but from the balance sheet to the payment date, that is your realized gain and loss. Okay. This exposure due to foreign currency is not only due to transaction, but later on we will discuss that is also due to translation of financial statements. Translation of financial statement is what we are going to discuss, is when we we have a business which is a multi-nation business, where we have three situations that we discussed, that we have a functional currency, presentation currency, and a local currency. Now, there is a possibility that two of these currencies may be the same thing. What is a presentation or reporting currency? Presentation or reporting currency is where the parent company reports its financial statement, the consolidated financial statement. So we took the case of Apple, where US dollar is the parent's reporting currency. Functional currency is from where it operates different businesses. That is a currency of operations or economic activity. For example, in Apple, we discussed that is Ireland, which is in euro. And local currency is what we exactly refer to, where your retail outlet is. Okay, that is, in our case, we discussed, let's say, a retail store in London, which is going to be in UK pound or Great Britain pound. So there is a possibility that all three currencies might be different. Okay. Now, this is called the translation of financial statement, and any changes in currency due to this is a translation gain or loss. Whenever I say translation gain or loss, there are two methods to measure this translation gain and loss. One is called the remeasurement using the temporal method, and second is what we say translation using the current rate method. And that which method is to be used, that's the best table for that is this. Everyone visible? So first thing, as I said, the three currencies. The three currencies, the parent's reporting currency, which is also called the presentation currency, PC. Functional currency is where the operations take place from, and the local currency is where the outlet might be, right? So PC, FC, and LC. Remember these short forms. Now, whenever the local currency and functional currency are same, okay, in that case, the only thing we have to do is that we have to translate from FC to PC, and that is done using the current rate method. So the translation takes place at a current rate method. This happens when the functional and presentation local currencies are same. But if they both are different, then we do the remeasurement using the temporal method. Here, the presentation currency and the functional currency will be the same. But what if all three are different? Then we have a two-step process. We have to first do the translation first, sorry, my mistake. First, we have to convert from LC to FC, that is remeasurement using temporal method. And then the second thing we will do is that we will do from translation from FC to the presentation currency using the current rate method. So remember always remeasurement is between LC and FC. Remeasurement is between LC and FC, and that is done at temporal method. Translation is between FC and PC, that is done at the current rate method. Is there any doubt in this first? And then we will proceed into what is temporal and current rate method. Any doubt, anyone in this? Everyone? Okay. Which method is to be used when everyone clear with that? Okay. Yes. Now, throughout the topic, there are different currency rates. One is the current rate, which is generally used for balance sheet because balance sheet is prepared at a point today. So that is the current rate. The second is the average rate or the historical rate. And the third, average rate is the rate during the year. Okay, this is generally used for income statement. And the third is historical rate, which is the past rate, which is used for balance sheet or the items that were bought in the past, or there can be any other date also. So current rate is for as of today. Average rate is generally used for income statement, and historical rate is used when, for example, most of the times in case of common equity when it was issued, or it is actual rate that was taken into consideration, the original rate when probably when the asset was bought. All right, these are the three rates that we need to focus on. So we will be using three different rates for both the methods, whether it is temporal or the current rate method. And we will understand what is the major difference amongst the two methods. Remember, temporal method is what we used whenever we are remeasuring from LC to FC. That is the first step. And the other method that we use, the current rate method, is we use it when we are translating from FC to the presentation currency. Now, most of the treatments are, the difference in the treatment is majorly on the balance sheet, that is of assets and liabilities. And that difference, if we want to see directly what the difference is, what we did is that we summarized everything, and that is out here as well as in our formula notes where we did the temporal method and the current rate method differentiation. So we will discuss both. First of all, I will discuss from here that if you look at the temporal method where we are doing what? Are we remeasuring or we are so there is something called, translating, or that is what we do. Translation is the word that we used for current rate method, that is from FC to PC. Remeasurement is what we use from LC to FC, all right, which is the temporal method. Now, under the temporal method, remember there is a classification between monetary and non-monetary assets. So what is monetary and non-monetary asset and liability? Remember, monetary is cash and equivalents, monetary assets. Monetary liabilities, remember all the three monetary liabilities, short-term and long-term debt and payables. These are monetary liabilities. Monetary liabilities and monetary assets under the temporal method, they have the similar treatment like the current rate method. Current rate method does not have a classification of monetary and non-monetary. Under current rate, they both are the same thing. Okay. Now, what is the difference under the temporal method? And you can actually check it from your notes also here, that under the temporal method, the non-monetary assets and liabilities are recorded at historical rates, that is of the past. Non-monetary asset and liability like fixed asset, they're recorded at the historical rates. But the monetary asset and liabilities are recorded at today's rate, that is on the balance sheet. And in the current rate method, it's pretty much straightforward. Whether it's monetary or non-monetary, both are recorded at the current rate, that is the rate today. Clear the first major difference about assets and liabilities? Everyone, this is clear? Okay. Now, because of this, if the foreign currency appreciates, where will you see higher value of assets? Under the temporal method or under the current rate method? Please tell me. Where will you, if the foreign currency appreciates, where will you see higher value of asset? Under the temporal method or under the current rate method? Yes, everyone? Check. Under the current rate method, isn't it? Because under the current rate method, the assets, especially the non-monetary assets, are at the current rate, that is today, compared to temporal, which is at the historical rate. So the difference is only due to the non-monetary asset and liabilities. All right. And if you have net assets, remember, if you have net assets, and if the foreign currency appreciates, if you have net assets, and if the foreign currency appreciates, foreign currency here means the local currency, if that appreciates, then which method will give you higher value? Which method will result in higher value? That is the current rate method. All right. But the historically, there is a positive net assets. Net assets means I talk about positive non-monetary assets. But what about the monetary asset and liability? Generally, companies have short-term debt, so they have more of non-monetary, more of monetary liabilities. Monetary liabilities. So they generally have net monetary liabilities. When you have net monetary liabilities, both the methods have actually the same impact. Both the methods use the current rate for monetary assets and liabilities. All right. So the issue is with respect to non-monetary asset and liabilities. Clear? Everyone? Check. All right. Okay. So see here under the temporal method, monetary asset and liability, non-monetary classification. Current rate is used for monetary asset and liability, but for rest of the thing, non-monetary asset and liability, including common stock and dividend, they all use historical rate, is the actual rate on the date on which the asset was actually purchased. Okay, so under all those cases, we use the historical rate. However, for income statement, whether it is temporal or current method, for income statement, generally we use here, especially in the temporal method, we will use the average rate for all the revenues and expenses, but not all expenses. Remember, we use the expenses related to the product cost, the average rate, but expenses related to non-monetary asset and liabilities use the historical rate. This is where the confusion is. So see, any expenses related to non-monetary assets, non-monetary asset use the historical rates under the temporal method. Okay. Under the current rate, there is no such issue. All the income statement, revenues and expenses, all of them are taken at the average rate. So what is the advantage? The net income is also average rate, unlike the temporal method. All right. The issue is with the temporal method where they use historical rate for non-monetary asset and expenses related to that. Therefore, their net income is a mixed rate. Common stock, they both use historical rate. That is the rate when the stock was actually issued. Correct. This is the major difference. Also, in the temporal method, any exchange gain or loss is recorded in the income statement, making it more volatile compared to current rate method where everything is recorded under equity, All right. So temporal method becomes more volatile compared to the current rate method. Current rate method is pretty much straightforward. I would suggest you to remember current rate method. Monetary asset and liabilities at the current rate because that's a balance sheet, equity at historical rate, and income statement at average rate. That's the best way to remember current rate method. In current rate method, any currency translation gain or loss is adjusted directly into equity. In temporal method, we use something called as adjustment, and that adjustment is into the income statement. In income statement, under the temporal method, we record it as a different thing. So all the adjustment related will go as a remeasurement gain or loss. That will be the case under temporal method. And that under the temporal method, it is a part of income statement, making it more volatile. Under the current rate method, we record something called as CTA. The remeasurement gain or loss is recorded in the CTA, which is under the equity under OCI. So CTA is an adjustment which appears only in the case of currency translation adjustment. This appears only in the case of current rate method. Everyone with me? Correct. So current rate method has, whenever you see CTA, that is with related to current method. Check, check, check. Everyone clear, clear, clear. Okay. Okay. Now, how do I find the ending balance of CTA? That is very frequently asked in exam. And whenever you see CTA, remember it's a current rate method. Okay. Now, when they ask you about calculation of CTA, we will see a case study where we will be solving the CTA related thing. CTA is actually a plug-in figure. So it is the balance that you will get when you do the overall calculation, whatever assets you have after. Remember, current rate takes into consideration what? Current rate is when you are converting from FC to PC, that is translating. While you do so, the cumulative translation adjustment, or just CTA, what you mean by that is basically the asset and the liability. The difference between asset and liability is your net equity. But whatever is the balance which doesn't match after translation, that is your CTA. So when we will be calculating the CTA is actually the balancing amount. So when we will be seeing the calculations, we have been given here examples. If you see here, what we did is that after converting all the assets and liabilities, remember balance sheet, monetary asset and liabilities are recorded at current rate, correct, except the common stock. So therefore, you will see all the cash and monetary and non-monetary asset, all of this under the current rate method are at current rate, except common stock, which is at historical rate. So from all these assets and liabilities, whatever is the missing amount, that is called my CTA. Everyone. And in the temporal method, you will see monetary assets are recorded at current rate, but non-monetary assets and expenses related to that are at historical rate, same like equity. This is the issue, and therefore here, whatever remeasurement gain or loss that you see, that remeasurement gain or loss is already in the income statement. It's not recorded separately as a CTA. So there is no CTA under the temporal method. Remember this thing. All right. What is the major significant difference here? That there is a possibility that the amount won't match, and in fact, the signs also don't match. All right. So there is a high possibility that they both won't match. What you need to understand is what is its impact on the ratios. See, there are two types of ratios: pure balance sheet and pure income statement ratios. These are pure ratios. Pure balance sheet and income statement ratios are the ones where what is the difference between a pure balance sheet income statement and a mixed ratio? Pure balance sheet ratios or pure income statement ratios are unaffected by the application of the current rate method. What do I mean by that? See here, under the current rate method, if I'm using the balance sheet, all the balance sheet items are recorded at the same rate, that is at the current rate. All the income statement are at average rate. So there is no issue when it comes to current rate method for the pure balance sheet or pure income statement. What is pure balance sheet and income statement? Pure balance sheet is where the numerator and denominator are both from the balance sheet. Pure income statement is where the numerator and denominator are both from the income statement. In this case, under the current rate method, there is no problem because they both are converted. The numerator and denominator are converted at the same rate. So all matters is that whether your foreign currency is appreciating or depreciating. Mixed ratios like return on asset, return on income, return on investments, or ROE. This is where their problem is. So a mixed ratio combines two different things. So is there a clear-cut analysis for this outcome? No, there is no clear-cut analysis, right? Mixed ratios, remember, you'll have to check individually one by one all the ratios. You'll have to see whether the local currency is appreciating or depreciating. If the local currency is appreciating, then the current rate is higher than the average rate. In that case, the denominator, which of, let's say, ROA, return on asset, the denominator will be higher. Asset values will be higher. And therefore, you will see the ratios will actually fall if if the foreign currency is appreciating. All right. In this example, what we saw is that the foreign currency was depreciating. If the foreign currency is depreciating, the average rate is higher and the current rate is lower. So therefore, the asset value will be less compared to the net income. In this case, you will see all the ratios will generally improve. So if you are looking for mixed ratios and if the foreign currency depreciates, it's a good news. Your ratios will look better after you convert from LC from which point? From FC to PC. Are you with me, everyone? Understood this part? So what do we need? If the foreign currency depreciates, it's a good thing. So whenever the foreign currency depreciates, especially in case of mixed ratio, see, pure balance sheet or income statement ratio, they are not affected. But in mixed ratio, if the foreign currency is depreciating, what will happen? The ratio, for example, ROE or ROA will be higher or lower? Higher or lower after translation? If the foreign currency is depreciating. Remember, if the foreign currency is depreciating, the ratio will be higher. If the foreign currency is appreciating, the ratio will be lower. This is very high chance of being tested up in the exam. All right. Understood this? Check, check, check. Clear? Clear? Okay. This is what we do when we are doing from LC to FC to the PC. All right. Very, very higher chance and higher possibility of this being tested up in exam. Now, in case of hyperinflation, there is an adjustment. What do we do in case of hyperinflation? Here, US GAAP and IFRS have a differential way of treating. US GAAP, first of all, they both also differ slightly in terms of definition of what is hyperinflation. US GAAP has a clear definition that if the cumulative inflation is 100% or more in the last 3 years, then it is hyperinflation. IFRS doesn't have a criteria, but it agrees with the US GAAP criteria. Okay. So both are hyperinflation. Under US GAAP, the functional currency is considered to be the parent's presentation currency. Functional and presentation currency are same. So what we do, guys? We use a temporal method to remeasure the financial statements. All right. But in IFRS, it's slightly different. IFRS says no, directly don't use a temporal method. First, you need to restate the inflated amount of the LC. Okay, so first we need to do the restatement. IFRS does not use temporal method in a hyperinflation. It says you can't use that. You first need to restate the financial statement and then you can do that. So first of all, restating means what do I need to restate? So they are saying the non-monetary asset and liability non-monetary asset and liability are restated for inflation. See, monetary assets and liabilities, they do not require restatement for inflation. Okay. Non-monetary asset and liability, yes, they were bought in the past, so they need to be restated. Okay. Most of the non-monetary assets are recorded at historical cost, so they will have to be restated for this hyperinflation. Again, non-monetary assets and liabilities only. Monetary assets and liabilities do not need that adjustments. All right. In fact, equities are also restated because equity is also recorded for the past value, right? So they will also be restated, correct? And the difference, the retained earning they are saying is the plug-in balance. Clear? Also, in the net income, remember we use the average rate. All right. So the income statements are restated by the price index because we use the average rate and the current highly inflation rate might be very different. Okay. So this is where we need to do the restatements. No one in the exam is going to ask you to do all the restatements one by one. But remember, the restatement is something that you have to do in IFRS. In IFRS, first you need to adjust those numbers for inflation, and then what you need to do once they have been restated for inflation, then you can translate into parents reporting currency. Then you can translate into parents reporting currency, which is done using the current exchange rate method. US GAAP says no. First, you do what? You first will have to, US GAAP uses temporal method. So remember, under temporal method, okay. Purchasing power, likewise, okay. So the gain and loss is recognized. Okay, this is what we discussed. So US GAAP uses temporal method. IFRS requires number one, restatement, and then it uses the current rate method. All right. This is with regards to inflation that we need to take into consideration. Okay. One important term that you need to remember is clean surplus accounting. What is clean surplus accounting? That the ending balance of retained earnings and the beginning balance of retained earnings is generally due to net income and dividend, right? But if this difference does not match, for example, beginning retained earning plus net income minus dividend should be equal to ending retained earning. But if it doesn't match, that is due to this currency translation gain and loss, that is called dirty surplus accounting. It's not clean surplus. Clean surplus is that clean surplus is only when the equation matches. If it doesn't match, which is basically because of the other adjustments like CTA, then it's called dirty surplus accounting. Is that clear, everyone? Okay. Yes. Also remember, all of this discussion was relatively easier because we reported only one of the subsidiary. If there are multiple subsidiary in multiple countries, then it is quite complex to do this valuation process. But all of these issues need to be discussed. All the limitations needs to be discussed in the footnotes, or you will also find them detail analyzed in the management discussion and analysis. All right. Clear, clear. Firms operating in the same industry may use different methods for translation, making it more difficult. Clear? So this is one thing. Remember, current rate method uses CTA, which is in the equity, correct? And if the temporal method you does every adjustment in the net income. So what you can do, one of the solution that they suggested is that adding the changes in the CTA to the firm's net income, so then they both are comparable. Clear, everyone? Okay. Then there was a discussion about the taxation effect. Remember the two taxation ratios. Effective tax rate is income tax expense divided by profit before tax, right? Statutory is decided by the state, correct? When they both do not match, remember we discussed in level one, that is a permanent difference for which you don't record a DT or DTL. All right. Changes in effective tax rate on accounting of foreign operations can be due to changes in tax rate itself, okay, or different countries, changes in the mix of profits from different countries. So if you're operating in multiple countries, there is an issue with different tax rates. All right. So therefore, the statutory tax rate and the effective tax rate might differ in this case. Clear? All right. Okay. Changes in the components of sales. What did we discuss here? Yes, remember your organic sales and the other, which is not due to organic. Organic sales is the sales which excludes the increase in sales due to two reasons. One is due to buying another company, that is acquisition or divestiture, or due to the currency effect. So organic sales is an actual sales excluding this sales. Okay, this tells you the sustainability of the sales. Clear? All right. That's it from this topic. Let me show you if there is anything. Yes, finally about inventory. Remember in inventory under FIFO, FIFO uses the latest COGS or LIFO uses the latest COGS. LIFO uses the latest COGS. So in LIFO, when it comes to COGS, we use the current rate. But older inventory, therefore historical rate. FIFO uses older COGS, so which are at historical rate, but ending inventory is at the current rate. Weighted average is between the both. Okay, clear, clear, clear. Okay, yes. Anything else? Yes. Okay. So I've also mentioned here that in the temporal method, exposure is mostly net monetary assets or liabilities. Okay, current rate, net total assets or liabilities. Okay, that is what is exposed to the currency. Correct? Because otherwise we use the current rate. In the temporal method, remember for net monetary asset and liability, we use which rate? Hello? Under the temporal method for monetary asset and liability. Remember under the temporal for monetary asset and liability, we use the current rate. So that is where we have an exposure in the current rate method, all of the assets and liabilities are using the current rate. So any change in the rate affects all assets and liabilities in the current rate method. Under the temporal, it is only the monetary assets and liabilities which gets affected by the exposure of the currency. Clear? Okay. Yes. What else did we discuss? The ratios we've discussed. Okay, that's it. Perfect. Now, again, until and unless we see a question, we will not be able to conclude how well we know the topic. So the questions are most, what I would suggest you is that you need to remember this, and this basically tells you what the adjustment is. What is, and most of the times they will ask you a question related to CTA. Yes, so we will also take a case study where we are going to calculate CTA. We are also going to calculate the remeasurement gain and loss systematically, and we will also see the impact on ratios. This is slightly complicated, and this is where students require a bit help. So unless and until we see question related to that, we will not stop. We will not be able to understand it completely. All right, everyone. Perfect. Now let's go to the topic of financial institution. Now see the remaining three topics, not too much of the thing is asked. So what I'll also do is that I'll focus on what is exam oriented from those topics. Okay, now when it comes to analysis of financial institution, here our major focus is going to be on banks and insurance companies, correct? So how are we going to basically evaluate them? What is the method of evaluating financial institutions? Okay, financial institutions, remember, they affect the entire economy. Especially we are going to focus here on the banks, which are highly regulated. Banks or insurance companies, they are highly regulated. Now, therefore, there is a global norm with regards to what is the minimum that they should maintain. That minimum required capital is decided by the Basel norms. As of now, we are under the Basel III norms, okay, which requires minimum levels of capital, liquidity, and stable funding. Okay, this is very, very crucial from your exam point of view. Minimum required capital, there should be enough liquid assets, and stable funding means the bank should have enough of the funding options, right? Enough of the liquidity. Again, it is related to liquidity. In case of whenever the bank required money, the bank should have enough of the funding options with them. Otherwise, the banks might go bankrupt. Okay. So there are various regulatory bodies to deal with this. We are going to understand the camel approach or the six factor approach for analyzing the bank. Okay. Here, the camels, actually it is camels, the sixth approach. The camel stands for capital adequacy, where we are going to calculate the ratios. Then the asset quality, management quality, earnings quality, okay, liquidity. L stands for liquidity and sensitivity. Of this, the capital adequacy, where we are going to understand what is the minimum quality or minimum capital required tier 1, tier 2. And then there is question regarding to the levels of earnings that we are going to discuss. And in liquidity, we have some calculation for the ratios. That is what the topic is all about. So when it comes to minimum capital, remember this, there is tier 1 and tier 2 capital. Tier 1 capital has common equity tier 1 and other tier. Common equity tier 1 is basically how much should be the common stock or equity of the bank. Here, it excludes intangible asset or any deferred tax assets. Okay, apart from that, whatever is the equity of the bank, that is the common under the common equity, all of that is your tier 1 capital. This should be 4.5 percentage of the risky weighted asset as of now. All right. In this, the other tier 1 capital includes related to preferred stock with no contractual dividend. So common equity, and then the second part is preferred stock. That is only the part of equity, right? Equity is common and preferred. So preferred stock with no fixed dividend. That is going to be, because fixed dividend is going to be then like a liability. So preferred stock without a fixed dividend is a part of other tier 1 capital. Together, tier 1 should be 6% of, you should maintain 6% of your risky weighted asset. And what is tier 2 capital? Tier 2 capital then goes to debt. So from common to preferred and now goes to debt. So subordinated instruments like bond whose maturity is more than 5 years. Okay, those are your tier 2 capital. Tier 2 capital and tier 1 capital put together, it should be how much, guys? 8%. Minimum capital that you need to have is 8% of your risky weighted asset. Okay, everyone. Risky weighted asset definition, you don't have to remember. It is given by the regulators, that how much is the bank's asset or deposits or assets. Sorry, bank's assets are loans which are risky. So those risky weighted asset minimum as per the Basel norms is what I've discussed here. For example, for common equity tier 1, it is 4.5. Then tier 1 total. Tier 1 total. Common equity is 4.5. Total tier 1 is slightly higher, 6% minimum capital. And tier 1 and tier 2 put together is 8%. 4.5, 6, and 8. Remember this. All right. Clear, clear, clear. Okay. Now, that is what is in the camel's approach. This is about capital adequacy. Remember, something like this will be tested in exam. Asset quality is about the loans that the banks have given, whether the banks have done proper thorough analysis of that or not. Okay. So what are these loans carried on the balance sheet, at what cost, amortized cost and all, or at fair value? That needs to be checked. So here, basically, we are going to see the quality, that the loans and the investments of the bank, that is about the quality of the asset. Okay. There should be less NPAs here, non-performing asset. Therefore, what we do here is the credit analysis. Credit analysis means we will also check for those which have a chances of default. So any off balance sheet adjustments will also be taken into consideration. Don't worry about any calculation with respect to this part. Then, as I said, loan loss provision, that is the non-performing asset. How much of the bank's loan are expected to default? That allowance for it is called loan loss provision. You need to keep some provision for those losses. It is mandated by many regulators. Okay, correct. Several ratios are used in this evaluation, which you can go through it once, you don't have to memorize it again. Okay, this is about the camel's approach. CA, asset quality. Management quality basically focuses on what? The controlling level of risk taken. Banks, internal control and governance system, and whether they are transparent or not. what is their approach with respect to what is the capability of management capability here focuses on the quality of the bank's management. Okay. And what decisions the banks takes, are they taking more risk or less risk? That is how the internal control of corporate governance system is. That is management control. This is a qualitative approach. Earnings, sustainability of earning is very important, right? And therefore, what is essential here is that banks invest in various securities. From that, they earn returns. So the valuation of that securities also is important. And these securities, if they are listed, we call it as level one input. If they are not listed, we use observable input like the discounted cash flow values. Okay. They are more volatile. Level three are when there is no observation. So that is quite subjective. That is the most riskiest valuation. Okay. Banks use different hierarchy to value their assets. Okay. Remember, the more subjective it is, the more, the if it is more subjective, then in that case, it is considered to be less qualitative earnings. All right. When it comes to liquidity position, there are two liquidity ratios that you need to focus on. That is liquidity coverage ratios. It tells you how liquid the bank's assets are. Very important. Remember this. Liquidity is highly liquid asset to expected cash outflow compared to the outflows that I have to pay to the depositors. How much liquid assets I have. Higher the ratio, the better it is. Okay. The second is net stable funding ratio, means the available funding compared to the required funding. Again, this ratio, higher the ratio, better it is. Okay. Remember both of these ratio, very crucial. Finally, the LSS relates to sensitivity of market risk. Sensitivity of market risk. Here we are going to do sensitivity analysis. Banks basically are very much affected by the interest rate risk, correct? Because banks have to manage the assets and liabilities. So the duration of asset of the bank is longer term for because the loans are for longer duration, but the liabilities like deposits are for shorter duration. So banks generally have a positive duration because their net assets are the duration of assets are higher, and therefore they are affected by the interest rate risk. So if there is an increase or decrease in the shape of the yield curve, or basically increase or decrease in the YTM, that will definitely affect the bank's balance sheet. All right, correct. So impact of change in the shape of the yield curve, or impact of any increase or decrease in the short-term rates because of the monetary system, that will affect the bank's portfolio, right? So for example, in the case of rising interest rate, what will happen okay, banks may have increased. So for example, rising interest rate scenario, if the assets are repriced more frequently, the bank's net interest income would increase. So in case of rising interest rate scenario, if the assets are repriced, assets means if the loans are revised, if majority of the loans are floating rate loans, that's a good news for the bank, correct? But also to benefit from the interest rate scenario, banks may increase their duration risk. They borrow more of short terms while lending for the long terms when they expect the rates will, when they expect, this is what will happen when they expect what. For example, the financial crisis, banks around the world reduce short term, they reduce short term rates, allowing banks to borrow. So majority of the banks do what? They borrow in short term when there is quantitative easing going on, and then they lend for long term. That's how they make, higher profits. All right, clear? Then there are some other factors which you can go to. Government support. Yes, government support is very essential for the banks in terms of quantitative easing. They absorb the losses. Government ownership is how much is the public sector's ownership of the bank. These are other factors. They are outside the camels program. Okay. Outside the camels. Plus the bank's mission. For example, if a bank is set up to help the poor and needy, they will have more of concentration of loans, which is risky. Culture of the bank, how diversified banks assets are, how do they do the corporate governance, their accounting policies and all the management, compensation, all of this is related to the culture of the bank. Okay. Here, how bank evaluates the liabilities is also very crucial, of balance sheet assets and liabilities. All of this is dependent on the culture of the bank. Okay, right? Then the remaining topic talks about insurance companies, two types of insurance, property and casualty and life insurances. Okay. Property and casualty insurances are relatively riskier. Okay. So in this case, what did we discuss? Their margins are cyclical, especially there is what we discussed, soft pricing period. Soft pricing during the price higher competition. Price cutting is done to get new business. That is called soft pricing period. Okay. They might operate at negative margins, correct? But the resulting reduction in competition leads to healthier pricing environment. When the profit margins are higher, that is called hard pricing period. All right. The business of property and casualty insurance is very volatile. Here, remember the two ratios that I have put up this year, which is high chance of being asked in exam, is the underwriting loss and the expense ratio. Both are measured in terms of the premium that the insurance companies get. Okay. Underwriting loss, see, whenever there are claims, right? Or any changes in the reserves, you have to put some reserves. That's a potential outflow. So underwriting loss ratio is the claims paid plus losses reserved. That you want it to be higher or lower? Well, you want this to be relatively lower. Okay. Second, expense ratio is expenses including commission to basically run the scheme, to float the scheme. This are also expected to be lower. Now, generally, these are also based on the net premium earned. For US GAAP, IFRS slightly uses differential year net premium return, the policy's return. Okay. Put together, we get a combined ratio. For your example, just focus on net premium earned in the denominator. Combined ratio is underwriting loss ratio and expense ratio, both of which you want it to be lower. Okay, everyone? Correct, correct, correct. Now, there is another ratio which is called loss and loss adjustment ratio, which is a replacement of your underwriting loss ratio. If you see there is in the underwriting loss ratio, it was claims paid, correct? Here, losses and loss adjustment ratio is loss expense plus loss adjustment expense. Okay. This is more accurate in terms of measuring the loss of the insurance companies. But there is one more thing. Insurance companies do have to pay some returns to the policyholders in the form of dividend. So any dividend paid is also a loss. So loss and loss adjustment and dividend paid, both are outflows by the insurance companies. Both you want to be lower. You can combine both, that is combined ratio after dividend. It measures the total efficiency of the insurance company's costs. All of this on the denominator net premium earned. So now put together, you have actually three ratios and a combination of them, two combinations of them that you need to remember. One is underwriting loss and expense ratio. Put together is combined ratio, both of which are on net premium earned. You want it to be lower. Then there is dividend policy, dividend to the policy holders, and the combined ratio. Both, when you combine them, it's called combined ratio after dividend. All of this ratio, lower the ratio, better it is. For your exam, underwriting loss ratio can be replaced with loss and loss adjustment ratio, loss and loss adjustment expense ratio that can be replaced. All of the ratios, just remember, divided by net premium earned for your exam. Okay. All the ratios, lower the ratio, better it is, except one ratio, which is on the insurance company. When they invest somewhere, they get returns. So whatever returns that they get on their investment is called total investment return ratio. This is the only ratio which is higher the ratio, better it is. Rest all ratios are the expenses related. So the lower the ratio, the better it is. Clear? All right. Correct. Perfect. That's it from this particular topic. Okay. This topic has these ratios that you need to take into consideration. All right. Now we'll move to the next topic, that is about financial quality reports. Anyone, any doubts till this point? Okay. Yes. Now in this topic, I will focus on the most important thing is the Benish model. Benish model talks about the reporting quality. See, there are reporting quality, that how your reporting should be complete, right? all the material information should be present. But earnings quality is about the sustainability of the earnings. Correct? So there are different ways to measure the reporting quality. And one of the very famous measurement, I will directly go to that quantitative tool, which is the Benish model. It's a eight variable model. There are eight independent factor. Multi-factor model is used to determine what? To determine the earnings manipulation, if there is any earnings manipulation or not. So it is called a probit regression model. Okay. It estimates the probability of any manipulation of the earnings using these eight models. Okay. And here the score, higher the score, higher is the probability of manipulation. Okay. So remember, you want the score to be the M square to be lower. Higher score means higher manipulation. Now, in exam, you are not required to memorize all these eight components. Understood? But you need to know the full form at least, and you need to know that whether the increase or decrease in that is a advantage or disadvantage. Okay. For example, the DSRI stands for days of sales receivable. Increase in that will increase the ratios, right? Gross margin ratio, gross margin index or gross margin ratio, it is actually the ratio, one of the ratio which is based, the ratio is previous year over the current year. Previous year or current year. When this ratio is greater than 1 means the previous year's value were higher, current year margins are lower. Okay. If that is the case, that shows higher manipulation, probability of manipulation. Remember, all of the ratio increasing is a higher chance of manipulation. AQI, what is AQI? Asset quality index. Asset quality index. So here it is actually the ratio of, I will also show you what exactly it means. See, check here, AQI. Where is AQI? AQI. Yes, AQI is the ratio of non-current asset other than the fixed asset like property, plant and equipment to total assets. So in that also relative to the previous year. So any increase in the non-current asset compared to that it indicates what? It indicates excessive capitalization. So excessive capitalization of expense, which is like a very aggressive thing, right? Right? Even that increases the chances of manipulation. Sales growth index. If you look at the sales growth index, the SGI depreciation. Okay, for sales growth index, here it is compared to the current year to the previous year. So here it shows you how is that going to be the manipulation here. So for example, if a company, this ratio is increasing, okay, that means there is a higher pressure of increasing the sales compared to the past year. Okay. Depreciation index is actually like the gross margin. See, it is from past year to the current year. Past year to the current year. Now, what is the issue here? If this ratio is greater than 1, means last year depreciation were higher, current year depreciation is lower. That means the depreciation rate is lower. That is done to increase the earnings. So this two ratio, gross margin falling or ratio falling or depreciation ratio falling, sorry, gross margin ratio and depreciation ratio increasing is a higher chance of manipulation. That actually means that margins and the depreciations are going down compared to the previous year. Both of that suggests higher chances of manipulation. Correct? Then selling general and admin expense or accruals or last leverage index. All of this, if they are increasing compared to the previous year, that is of increased pressure, and that means there is a higher chance of manipulation. This is your M score using the Benish model. It tells you basically whether the probability of manipulation is higher or not. Okay. Remember, the Benish model depends completely on the accounting data, and therefore it is based, and the management knows this, so they can actually game this. Understood? So that is the disadvantage of the Benish model. The second approach is using the Altman score, but the Altman Z score is actually used to find the probability of bankruptcy. Okay. So Benish model, and then there is Altman Z score, which we also used in fixed income, is actually a Z score using 5 variables to measure the probability of default or the bankruptcy. Okay. The limitation of this model is also it's a static model. Okay. Each variable is positively related to the z-score. So any ratio increasing here will result in a higher chances of default. So here you have net working capital, retained earnings, sales, EBIT, all of that to the total asset. So any increase in proportionate increase compared to the total asset of all of this, okay, that results in a higher probability of bankruptcy. Market value of equity to the book value of liability. Okay, yes, market value of equity to the book value of liability. All of this are positively related to the z-score, everyone. So what is the conclusion? Higher the z-score, higher the z-score. Yes, check, 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 check. Higher z-score is considered better. All of this will increase the, did I say something else? Okay, so first of all, any increase in these ratios, all of these ratios will increase my z-score, and higher z-score is good sign. How ratio 5 increase probability of default? Ratio 5? No, none of the ratios. I meant all of the ratios increasing will increase my z-score. Compared to Benish, where increase in ratio increases the probability of manipulation, in Altmer, it is the opposite. Any increase in all this proportion to the total asset will increase the ratio. And increasing the ratio will increase the z-score. Z-score higher means the chances of default are lesser because Altman focuses on earnings quality. So do you want Altman score to be higher? Yes. That means the earnings are relatively more sustainable, and then therefore the probability of bank default is less. Understood this? Okay. So Benish, I want the score to be low, M score low. That is about financial reporting quality. Altman is about earnings quality. I want the ratio to be higher. That is where I want the Z score. If the ratios are higher, guys, the Z score is derived from the ratios. The Z score will be what? The Z score will be less, and Z score is going to give me the probability. Understood? Basically, if higher the ratios, lower will be the probability of bankruptcy. Clear? Again, one more problem here. It is also dependent on accounting data. So both the Benish as well as the Altman, they both are relied on accounting data. So that is the limitation of both. All right. Clear? Yes. Now we move to the discussion of sustainable or persistent earnings, which is where we need to compare the earnings of the current year with the previous year using a regression model. So that helps us understand the persistence of the earnings. And here the slope or the beta will basically, higher the beta means higher is the persistence of the earnings. It's like an AR model. Okay, AR single model, because you're going to the past year, one past year, right? So higher the sensitivity here, the higher is the persistence of the earnings. All right. Then, because we are doing accrual accounting, okay, the earnings that you have actually earned, that will be converted into cash or not, it's not certain, right? So therefore, the model is now taking into the cash component also. So now, along with the current year cash flows and accruals, both are taken into consideration when it comes to earnings. Everyone. So here I have cash flow and accruals. So accrual component of income is less persistent than the cash component. Everyone, this means beta 1, which is about cash flow, is more impactful than beta 2. If that is the case, then what will be my conclusion? It is important to recognize that some accruals occur as a part of normal business, right? Such accruals are called as non-discretionary, and other comes from the discretionary part, which are manipulative. Okay, so if my accruals proportion is higher, that shows a red flag. That is a clear sign of manipulation, right? So if my current earnings are highly related to the cash flows, right, then it's okay. But if they are more related to the accruals, then it is not. Clear, everyone? Okay. These two things I've measured here, that both are actually AR1 model. So here my earnings are just based on the previous year earnings, correct? But if I take into account the cash flows also, how will I say there is higher persistence? Higher persistence is in the normal earnings model. If the beta is higher, and in the AR1 model with cash flow and accruals, if majority of my earnings are dependent on the cash flow, that means beta 1 should be higher, then I will say there is higher persistency of the earnings. Clear, everyone? Correct? Correct. Rest of the thing of this topic is quite theoretical. You can go through that, which is based on your general knowledge. What else is important? Completeness. Yes, yes. Okay, clear presentation. Okay. Okay. Yes, just one new thing that we basically came across here is what are the informations that you need in regards to understanding the different sources of information that you have apart from the company's 10K reports and all. One is the SEC filing NT. NT is basically when the firms don't file the information on time. That is where they have to, if they are not able to file on a timely manner, that shows you the quality of the management. Okay. If the managements have to consistently file NT with the SEC, that means they are not doing it on a timely manner. This is one unique thing that we had to discuss. All right. Correct. That's it from this topic. That is about, we were discussing about evaluating financial reporting and earnings quality. Correct. Now we move to the last topic, that is integrated financial statement analysis, or basically we are going to consolidate everything and analyze. Now in this topic, one very important ratio is the ratio of ROE DuPont. Okay. And we also discuss about the steps of financial statement analysis, same like level one. First, there should be an objective collecting the data. 10K report processing is where you do the ratios, common size financial statements, analyzing and putting up the conclusions, and then following up on a consistent basis. 6 steps, exactly same steps as what you did in your level one. But now comes the DuPont ROE detail analysis. So sources of ROE is what I discussed here. A 5-point ROE. ROE is net income over total equity, right? Which is net profit margin, asset turnover ratio. And between that, you can also split it further. So net profit margin can be split up into tax burden, interest burden, operating margin. Correct? Then you have asset turnover and financial leverage. That is a 5-point DuPont ROE. Sometimes they, instead of giving you the tax burden, what they would do is that instead of giving you tax burden directly, they will give you earnings before tax and tax information. So from that, you can get actually the tax rate. So 1 minus tax rate is your tax burden. So if their tax rate is 50%, 40%, 1 minus that is your tax burden. Tax burden is net income over EBT, which can, and net income can also be derived from EBT minus tax. That is net income, right? EBT minus tax is nothing but 1 minus tax rate. Remember this in case if you are not able to directly find the tax burden. All right. Correct. Higher chance of this being tested in exam. It's very easy also, by the way. Okay. You've already done that. Now, the second thing that we discussed apart from the earnings quality related calculation is about the capital structure. Yes, yes. A firm's capital structure must be able to support the management's strategic objectives. Okay, so company should have sufficient sources of capital, right? Financial liabilities and bond liabilities can be placed in default if not paid on time. That is what we already know, right? There's nothing complication there. What is more important in this particular topic apart from this? Is there anything that we need to take into consideration? Yes, the accruals ratio. Accruals ratio. Measure accruals as the change in the net operating asset. two ways to calculate the accrual ratio. By the way, what is accruals ratio? It is related to the earnings quality. It tells you basically the accrual ratio. It will it will differentiate between the earnings which came from cash flow and which came from accruals. Two approaches we use, the balance sheet approach and the cash flow approach. In balance sheet, I'm going to use net operating asset difference divided by the average value. That is called the accruals ratio. Remember, balance sheet ratio is the difference in the net operating asset. Net operating asset is operating asset. Net operating asset is what? Operating asset minus operating liability. And what is operating asset? From the total asset when you exclude the cash and equivalents. And from the operating liabilities, you exclude the cash liabilities like short-term and long-term debt. That is called your operating asset and operating liability. So NOA difference, ending minus beginning, divided by the average. That is your accruals ratio using the balance sheet approach. Okay. Using the cash flow approach, we can derive the accruals by subtracting CFO and CFI from net income. So the numerator is what you change. Only the numerator you change, correct? The denominator you keep the same. Both are my accruals ratio. Understood? Both ways, both approaches are acceptable. These both are going to be your accruals ratio. Do you want them to be higher or lower? Yes. Do we want them to be higher or lower? If there is a growing this, yes. Do I want it to be higher or lower? Aggregate, yes. Accruals ratio. What does it measure? What does it measure? What does it measure? With either approach, the ratio of can be used to measure the earnings quality. The lower the ratio, the higher is the earnings quality. Means relatively your earnings have lesser proportion of accruals. Remember, both the ratio, lower the ratio, better it is. We want these ratios to be lower. Understood? We want this ratio to be, sorry, accruals ratio, we want it to be lower is better. Is that clear, everyone? Lower the ratio, the higher is the earnings quality. Clear, everyone? This part, right? So we want lower. Lower means higher earnings quality. So we are basically measuring the earnings quality. And therefore, both of this ratio, the lower it is, the better it is. Clear, everyone? Any doubt? Anyone in this case? Check. Right? Okay. Now, one last thing that we actually calculated in this is the standalone valuation. Okay, because see, when you are going to value a company, right, it also takes into consideration after the acquisition. What happens is that it takes into consideration the the consolidated value, right? That is called the standalone valuation of the company and standalone PE ratio. But before that, there was just one small difference with respect to the CGO. Well, you have heard CFO, that is cash flow from operation. But cash generated from operation is only one difference, that instead of net income that we use in CFO, you use here EBIT. That is cash generated from operation. Just keep that in mind. Okay, that's the only new thing here. But what is market value decomposition? Market value decomposition is when you're going to separate the standalone value of the acquiring company compared to basically the parent company from its associate. Because when you prepare a report, the associate or values is also subsidiaries value is also part, right? So what is the standalone value of the parent company that we want to identify, right? So when a parent company has ownership in associate, it may be beneficial to determine the standalone value of the parent company. The implied value is equal to parent's value less the parent's pro rata share in the associate. Okay, or any gain or loss which is not related to the parent's financial statement, including any foreign, including if the associate is foreign stock exchange, it may be necessary to convert market value into the parent's reporting currency. So basically, you need to exclude the subsidiary's valuation, whether it's the market cap or in the PE ratio. For that, we derive the formula So implied value is the parent's value minus the subsidiary's market cap, correct? But when it comes to subsidiary's market cap, how much is the subsidiary's market cap that we need to subtract? So in the subsidiary's market cap, I actually put this wrong place. Okay. So remember, subsidiary, when it comes to valuation, we are going to exclude our proportionate share in the subsidiary. So our proportionate share in the subsidiary's market cap and any adjustment for currency. So if we are using the current rate method, we will have to take the currency rate into consideration, right? So parents reporting currency at the current rate, because it's about the balance sheet, the equity value, the balance sheet value at the current rate, right? But when it comes to earnings, from the parent's earnings, we will subtract the subsidiary's proportionate earnings. But when it's earnings, we take the average rate. Remember, income statement is at the average rate. So again, value of the company, implied value of the company will take into consideration the parent's value minus the subsidiary's proportionate share adjusted for currency at the current rate. For standalone earnings, parents' earnings minus the proportionate share of the subsidiary's earning adjusted at average rate. Once you get the price and the implied price and implied earnings, you can actually get the implied P ratio also. All right, everyone? Clear? Right? That's it. This is the end of all the formulas of FSA. Correct? Too many formulas. I've summarized all of them, right? It will take you good amount of time to revise that. But then now when we do these case studies, I have covered almost all the varieties of the case studies. So we will process that and we will see how everything that we've learned and all the formulas that we've done are sufficient for us to deal with the exam. The exam is not as complicated as so much of information is. All right. So let's do that. Correct.